I want to quickly talk to you about Schedule K-1 Form 1065. And in today's conversation, this will be a walkthrough. But this is only for 1065 because you also have Schedule K-1 for Form 1120S. But this is about 1065. So here's an overview I want you to pay attention to. I want to first cover Part 1 and Part 2 of the form, and then later on, I'll cover Part 3. So before you do anything, don't forget to put the dates to which the form pertain. So here we have January 1st, 2023 to December 31st, 2023. In Part 1, you have to put identified information about the partnership. So first you have to put the partnership's EIN. So the EIN can be seen on any correspondence that you have with the IRS. Not a problem there. Then you have to put the partnership's name, address, city, state, and zip. Also not a problem there. And you also have to specify the IRS center where the partnership filed the return. So remember that Schedule K-1 is always tied to the Form 1065 or 1120S. In this case, it's Form 1065. So where you filed the Form 1065, you have to actually put the IRS center. You have to indicate it here. So in our case here, this is in Kansas City, Missouri. And so that's Part 1. Part 2, you got to put information about the partner because the Schedule K-1 is actually tied to a partner. So you have first you put information about the partnership, then you have to put the same, you kind of put something relevant about the partner. So you have to put the partner's social security number or ITIN, so individual tax identification number. You put that there. And you have to put the name, address, city, state, and zip of the partner. Okay. Remember, Part 2 is all about the partner. So then you have to really indicate whether you have this partner is a general partner, limited partner, and or something else. So here we are choosing a general partner or LLC member managed. Okay, member manager. Then you have to really put the allocations, the profit and loss allocations that you have within the partnership. In this case, we put 40%, 40% gain, 40% loss, and the capital is 25%. Okay, remember that when you add all those three, they don't have to reach 100%. It's not, this is not how it works. Okay, we are still talking strictly about the partner, that particular partner's percentage allocated to him or her. And you put in K-1 here, the partner's share of liabilities. So the beginning and the end. So we put that there. And in terms of, you also have to do the partner's capital account analysis here. So the beginning capital account, the capital that was contributed during the year, the current year net income or loss, and the other increase. And so we have to put all those information, all that information that relates to the partner's capital account analysis. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. I want to first talk to you about where to file your taxes for Form 1065. It's really important to understand that everything depends upon the location of the partnership. So as you can see on the screen here, if the partnership's principal business, office, or agency is located in a specific state, you are going to file. You're going to file in a certain revenue service center. Okay. And so you can see on the screen here, everything depends on what kind of location you have and the size of your balance sheet. So for instance, if the total assets at the end of the tax year are less than 10 million and Schedule M3 is not filed, you have to go to the Missouri one. If the total assets are 10 million or more or less, if you will, and Schedule M3 is filed, you have another location. So you can see that in our case, if I were to go back real quick to the part 1 of our Schedule K-1, you can see that Part 1, Section C, I put here IRS Center where the partnership filed the return, Kansas City, Missouri. And if you go back to this form, it's because basically our partnership has less than $10 million and Schedule M3 is not filed when we file the Schedule K-1. Okay, so it's important to really understand that. And in some cases also, you have to really think about the recourse versus non-recourse debt, because when we talk about the IRS forms on Schedule K-1, there are two types of debts, and you have recourse and non-recourse. So a recourse debt holds the borrower personally liable. All other debt is considered non-recourse. Why is this important? I want to quickly drive you back to the Schedule K1 Part 1 and Part 2. Specifically, if you go to Part 2, you will see that in Section K1, partners' share of liabilities, you have recourse and qualified and non-recourse financing. That's why, and then you have recourse. That's the definition of recourse versus non-recourse liability. Okay, and another thing I want to talk about also is that you have a Section 1250. So Section 1250 really is a rule establishing that the IRS will tax a gain from the sale of depreciated real property as an ordinary income if the accumulated depreciation exceeds the depreciation calculated with a straight line method. And so Section 1250 is an entire topic that we have a show that we really soon will cover. And I don't want to waste too much time here because it's a long topic, but it's pretty interesting one though. That's very important for partnerships. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about Schedule K1 Form 1065. Now let's talk about the Part 3 of the form. So Part 3, you can see here the Part 3, you have to put the ordinary business income or loss. You have to put the net rental real estate income or loss. Other net rental income or loss, of course. You have guaranteed payments for services. And so if there are any guaranteed payments for capital, you put that here. So you can see that the total guaranteed payments, that's basically guaranteed payments for services plus guaranteed payments for capital. Those are the two. So in our case, that's 100 grand. So anything from interest income all the way to royalties, it doesn't apply to our business, but you can actually just fill it out with data that pertains to your business. And so the net short-term capital gain or loss, in our case, 25 grand. Net long-term capital gain or loss, 45 grand. So in our case, we only had gains. And so anything from 9B all the way to 11, nothing applicable to our business. Section 179 deduction, 37,500. And what I want to say here is that it's important to understand that, especially for Section 179, you got to back it up. You got to substantiate. You got to have some kind of records, because the IRS is pretty adamant at auditing all partnerships that really claim this Section 179 deduction. Okay, and so next thing I want you to do here is to look at Section 22. It says here more than one activity for at-risk purposes. And so it's one of those things where you have to actually, if you want to claim certain deductions, the activity must be at risk. Because if you only have it on a passive level, then you cannot actually claim certain expenses. This is another topic for another day, but I just wanted to specify that here so that we are all on the same page when it comes to what is deductible and what is not deductible on a Schedule K1, especially vis-a-vis the partner's income taxes. So let me give you the approach you need to really think about. So what is a Schedule K1, by the way? So I showed you before. I just showed you what a Schedule K1 looks like. Now let's talk about the theory behind Schedule K1. Now, Schedule K1 is a schedule of IRS Form 1065. And so it's basically provided to partners in a business partnership to report they'll actually report their share of a partnership's profit, losses, deductions, and the credit to the IRS. And you need to understand that you fill out Schedule K1 as part of your partnership's tax return Form 1065, which then reports your partnership's total net income. Now, if you are listening to me right now, if you are a partner in a partnership, let's say you have an LLC that by default is filing Form 1065, you actually, when you file Form 1065, all the schedules, including Schedule K1, they are attached to the Form 1065. Okay, so, but the thing is that the partnership itself is not paying taxes, right? Because the 1065 is an information return. So something you send into the IRS to let them know, FYI, this is what's happening in our business, okay? But you're not paying taxes. And so that's why The partnerships are called pass-through entities because they don't actually pay taxes. Rather, all income or loss, tax deductions, and tax credits are distributed or passed through to the partners to report on their income tax return, okay? So if you want to find a sample K-1 tax form, just actually go to the IRS website and you probably will probably see what it looks like. But normally you will receive actually Schedule K-1 from your partnership, and you have to receive this by March 15th. Okay, that's the deadline because basically you got to have the Form 1065 first to file your own. If you're a partner in the business, to file your own business, to file your own tax return. So when you file your Schedule C Form 1040, you got to include information on that form. Okay, now who has to file Schedule K-1? Well, if you are a partner in a partnership that's required to file a tax return for the year, then you will receive a K-1 that lists your portion of the partnership reportable items. You need to do at least two things during tax season. Make sure your partnership has filed a partnership tax return, tax form 1065, and issued K-1s to all the partners. And then you have to report the items on your individual Schedule K-1 at the appropriate places on your tax return. So this is really important. And one thing I need to say here is that there are actually two additional forms that the IRS calls Schedule K-1. Actually, not one. I thought it was two. It was one, but not. It was actually two. So you have Schedule K-1 or Form 1041. Then you have a Schedule K-1 or Form 1120S. Now let's talk about K-1 allocation. I want to talk to you also about K-1 versus 1099. So when we talk about K-1 allocation here, we're speaking about the allocation of profits in a partnership. That is actually, this allocation is done according to the partnership agreement created by each of the partners. So basically what happens here is that each partnership decides for itself how it will allocate earnings and other items such as interest and charitable contributions. So even if a partnership has not distributed any cash to the partners will be allocated their share of income or loss. Let me give you an example. If your allocation of the earnings is, say, $75,000, but you only took 25 grand in draws throughout the year, you will still be taxed for the full 75 grand because that's income to you. See, the IRS is not really accounting the income you took out. It's the income that you earned. So if you earn 75 grand, you are taxed on that 75 grand. So let's talk about K-1 versus 1099. So your partnership receives 1099 forms from your clients if they paid you more than $600 during the year. So when you add up the total income from all the 1099s, you'll get most, but not all, of the income earned by the partnership during the tax year. Now, this information can actually be used to file your Form 1065 on behalf of the partnership. In other words, 1099 forms are relevant for reporting the income of the partnership as a whole. As a whole, this is critical, as a whole. So Schedule K-1 is actually relevant to the individuals of the partnership when reporting their share of the profit or loss on their income tax return. So a partner will almost never receive a 1099 from the partnership that they own, okay? So it's important. So what about self-employment tax K-1? Well, Schedule K-1 will show you your self-employment earnings from the partnership or LLC you are a member of. So you need to pay self-employment tax on that amount. And it's one of those things where you have to really see how your situation sort of shapes up. But like anything else, there are a few exceptions when it comes to self-employment K-1. But it's one of those things where you have to really, if you need more answers or if you have questions, let us know in the comment section, and one of our team members will get back to you to explain a lot further. The thing is that, Schedule K-1 is not that complicated, but you need to have some rules. You need to know some rules or some keys, if you will, to know how to read the form properly. Okay, so when we talk about Part 1, information about the partnership, here you really need to enter everything about the partnership. Okay, it's about the partnership, the EIN about the EIN of the partnership, the geography, the location where the company is actually conducting business, and so on and so forth. So nothing complicated. But there is a section on Part 1 where you have to actually indicate if your partnership is a publicly traded partnership with shares that are bought and sold on an established securities market. And so that's part one. Part two, as you probably saw when we started the conversation, you had just to mention stuff about the partner. So here we're speaking about you talking about the partner in terms of the partner's social security number, right? So you have to talk about the partner's contact information. Now, this is you though, because you are the one receiving the to receiving the Schedule K-1. So everything you have to put is about you. And so it will be your social, it will be your partnership's your share of the partnership's profit, loss, and capital. And remember, generally speaking, these amounts are based on the business's partnership agreement. But I want to establish once again that you still have to pay taxes whether or not you have taken the money out or whether or not you have spent the money. Because some partners say, you know what, I'm just going to keep the cash in the business. Even if you don't keep the cash even if you keep the cash in the business, you're still liable when it comes to taxes, okay? And because when you keep money in the business, or you want to keep profits in the business, that's called retained earnings. And the retained earnings are still earnings anyway, and you have to pay taxes on those earnings, okay? So this is so there's a difference between what you decide to do with the money versus your tax liabilities, okay? And yeah, so in part two, you talk about you, the partner, everything else that relates to your allocation of the partnership's loss, income, and profits, okay? So part three, this is where you have the partner's share of current year income, deductions, credit, and other items. Now the thing here is that the gist of this section is that you are basically reporting to the IRS your share of the partnership's income, loss, deductions, credits, and anything else needing to be allocated to you in connection with your stake in the partnership. Again, everything relates here to the partnership agreement, so you have to be clear about that. And so we're talking about ordinary business income, net rental real estate loss, okay, other net rental income. So you also have guaranteed payments. By the way, guaranteed payments are payments that the partnership made to you without regard to the partnership income, usually in exchange for services or for the use of capital. So those are basically, again, without regards to the partnership's income. And then the rest is pretty self-explanatory. We're talking about royalties, dividends, net short-term capital gain, loss. So I showed you this before to sort of give you some context as to what kind of rules and regulations you need to follow, okay? Now, when are K-1s due? Well, businesses operating on the calendar year must file Form 1065 by March 15th, unless you file a 6-month extension using Form 7004. And March 15th is also the deadline for partnerships to issue individual K-1 to their individual K-1s to each partner, which will give individual partners a little under a month to file their personal federal income tax return on April 15th. So this deadlines move to the next business day if they fall on a weekend or a holiday. So the thing is that businesses using a fiscal year must file the tax return and provide a Schedule K-1 form to each partner no later than the 15th day of the third month after the end of their fiscal year. When the partners file their individual tax returns, they must use the Schedule K-1 from that year. Okay, this is really important to really stick to the year when it comes to this analysis. And let me give you an example. If the partnership's fiscal year ends on April 30th, 2024, Schedule K-1s must be provided by July 15th, 2024. Each partner will then use the information on Schedule K-1 on their 2004 tax return, which is filed in 2025. So calculating each partner's share of each Schedule K-1 item can be complex and time-consuming. So we actually recommend that you hire an expert to help you file to make sure that you get it in on time. Thank you so much for your attention. Really appreciate it. In today's conversation, I give you a walkthrough for Schedule K-1 Form 1065, and I give you the overview, the approach, and then now the recap. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.